Markets hit the brakes today. The Dow, S&P 500, and Nasdaq all stalled after a hotter-than-expected PPI report, Producer Price Index, cooled the recent rate cut rally. What happened, why it matters, and what you can do now, in plain English. Wall Street had been rallying on hopes the Federal Reserve will start cutting interest rates soon. But today's PPI, wholesale inflation, came in hotter than forecasts, suggesting inflation pressures aren't easing as smoothly as investors hoped. That headline was enough for stocks to pause and futures to wobble as traders reassessed how aggressive those rate cuts might really be. Tech held up better at times, but the broad market lost momentum. Quick definition: PPI measures price changes businesses receive for goods and services. Think of it as upstream inflation that can flow through to consumer prices later. How and why it happened? Two forces collided. 1. Data versus expectations. Investors had priced in a friendly path to Fed cuts after earlier, cooler inflation reads. A hot PPI contradicts that narrative, implying persistent price pressure in parts of the economy. When the story changes, prices adjust, hence the pause. 2. Policy mechanics. Rate cuts depend on convincing evidence that inflation is on a sustainable path lower. A hotter PPI makes the Fed less likely to move quickly or aggressively. Markets reprice those odds in real time, often through stock swings and bond yield moves, so the equity rally caught a speed bump. What it could mean: the investor lens, potential positives, resilient leaders. High-quality, cash-rich companies can weather slower rate-cut timelines and may even gain share while weaker peers struggle. Tech megacaps sometimes hold up if earnings power is durable. Valuation discipline. Pullbacks can reset frothy pockets of the market, creating better entry points for long-term investors. Potential negatives: multiple compression. If rates stay higher for longer, valuations, especially for long-duration growth stocks, can face pressure. Broader risk appetite cools. Sectors dependent on cheap financing, unprofitable growth, some small caps, can stay volatile as rate cut timelines get pushed out. Not financial advice, just a framework to think with. 1. Recheck your time horizon and risk. If your thesis depended on quick Fed cuts, stress test it for a cuts later scenario. 2. Lean into quality. Positive free cash flow, strong balance sheets, and pricing power are your friends when inflation proves sticky. 3. Diversify rate sensitivity. Balance long-duration exposures, high growth, with cyclicals defensives, so you're not betting on one macro outcome. 4. Mind your bond side. If you hold fixed income, review duration. A slower path to cuts can mean choppier prices for longer duration bonds. 5. Use volatility with a plan. Consider dollar cost averaging on names or broad ETFs you already wanted. Pullbacks can be opportunities if your thesis is intact. 6. Watch the next catalysts. Upcoming inflation prints, jobs data, and the next Fed meeting will reshape the rate cut path again. Keep an eye on credible market coverage so you can respond, not react. Today's takeaway: one hot PPI doesn't decide the entire year, but it does remind us the path to lower rates may be bumpy. Build a plan that survives different scenarios, and let volatility work for you, not against you. And hey, if you love staying ahead of the market curve without falling asleep halfway through the news, hit that subscribe button and join our growing community of money-smart investors. Drop a comment telling me if today's news changed your game plan, or if you're holding steady. Smash that, like if you learned something new, and share this video with the one friend who still thinks PPI is a new energy drink. Because the market moves fast, but together, we move smarter.